Hello and welcome to Bloomberg Quint. JK Papers has come out with a good set of numbers with revenues increasing by 11% and also margins expanding by more than 200 basis points. Joining us to dissect the results, we are having V. Kumaraswami, CFO of JK Paper. Hello, sir. So can you tell us the reason why...
Nice to be on your show, yeah.
Sir, can you tell us the reason why there has been a top-line growth for this quarter?
The top-line growth has been supported by very good market conditions, as you know. And we have also continuously worked on this product mix changes, both in our writing and printing segment as well as the board segment. With the result, we've got about 10 to 11% growth in our sales figure, both at the gross and the net level. Apart from that, of course, as you know, the margins have also increased based on further control of costs, optimization of power and fuel further. Raw material supplies have been very good. And as you know, the interest costs have been coming down sharply, quarter on quarter because of debt repayments, as well as the better rating of the company is leading to, better interest rates for the company. So going has been good.
And sir, how has the pricing been over the last few months, and any pricing changes you're expecting going forward in the next months?
Prices have been good in the last about 2 or 3 quarters. However, there is some kind of a maybe an emerging pressure because the dollar also has retreated a little bit. So whatever the imported quantities are coming into India, especially in the coated paper, there has been some softening expected. And writing and printing is going horizontal, and so one has to see how it pans out in the future.
Sir, can you please tell us about the input costs, especially lumber and pulp? So what changes can we expect in their trends and the impact on your margins?
See, pulp costs have some direct bearing in the coated paper, and the coated paper prices are built up as a conversion cost plus coated, the pulp prices. So they move in tandem, but in the other cases, it's the impact is somewhat muted. And as you know, in the copier grades, there is now an 855 as the minimum price at which we can import. So so the import pressure and the dumping pressure is somewhat eased off in coated paper. So nothing can be sold within India at prices at less than that. So the pressure from imports in that segment is a lot less. But however, that may not be the case in the other writing and printing segments. And board, obviously, there has been some, good price uptick in the last about 2 or 3 quarters. But of course, India doesn't import much of board. So that is if you look at the overall price to pulp scenario, it varies from grade to grade. And but better prices help us in the board because we are still importing a little bit of pulp for our board segment.
So what is your capacity levels and what is your utilizations level coming in?
Capacity is supposed to be about 450,000 tons, but we are almost at 110% capacity utilization, about 490 or so. I'm talking about the annual rate I'm talking about. And, Sirpur should be adding about 140 or something come August, September next year. So overall will be almost about about 6.5 or so by maybe in the next about 6 to 7 months.
And speaking of your debt picture, how is your debt stacking up along with equity?
Which one?
What's your current debt? Yeah, so the question is, what is your current debt level and how it is stacking up against equity?
See, the current levels at the gross basis is somewhere about 0.82 or something, and at the net level almost half of that to the total net worth. If you're talking about the total number, including the working capital, at the gross level will be around 1,450 to 1,500 crores. And if you talk at the net level, maybe about 650 to 700 crores. So debt levels are comfortable, and the debt equity as well as the debt to EBITDA levels are quite comfortable or are at their historic lows for us.
All right, sir, we leave it till there. Thanks for talking to Bloomberg Quint.
Oh, thank you so much.